The global pandemic that began in early 2020 has brought about lasting changes worldwide. The high demand for various items during this time led to scarcity and significantly increased prices. The car market was also affected by these circumstances. It is important to understand why this happened. The global pandemic that emerged in early 2020 has brought about lasting transformations across the globe. Numerous commodities faced scarcity as a result of heightened demand, leading to difficulties in obtaining them and a significant surge in prices. Even the car market was not exempt from these effects. It is crucial to comprehend the underlying reasons for this. Among the factors, the primary one was the chip shortage that halted the production of new vehicles, consequently causing a sharp increase in prices for used cars. It's worth noting that this chip shortage was a direct consequence of the COVID-19 pandemic, and the subsequent Russian invasion has further exacerbated the situation. However, as the saying goes, time has a way of healing wounds. The challenges we currently face will not exert perpetual pressure, and there are signs of improvement and relief in certain aspects of life. This is not to negate the fact that the world has been permanently altered, but there may be a glimmer of hope on the horizon. By first comprehending the underlying causes of the surge in the car market, we can then monitor any shifts within those causes and potentially anticipate a positive change that would benefit prospective buyers. A global crisis emerges. In the year 2020, there was an undeniable certainty that a recession had descended upon us. The outbreak of the virus led to widespread shelter-in-place orders, causing a significant reduction in people's mobility and consequently diminishing the need for cars, with many individuals either working remotely or facing unemployment. The demand for vehicles significantly declined. Unlike the Great Recession experienced from 2007 to 2009, this time, the economic downturn was not aggravated by soaring gas prices or credit lending issues. Nevertheless, the impact was severe, as evidenced by the staggering number of 16.8 million new unemployment claims filed between March 15 and April 4, 2020. The reduced need for travel and the widespread unemployment posed significant challenges to car sales. Dealerships had to adopt unconventional measures to attract buyers, such as offering 0% interest loans for an extended period of 84 months, which is notably longer than usual. These terms were deemed necessary to facilitate transactions in such a difficult market. Generous purchase and lease packages were made available to entice new buyers. Dealerships, driven by their desire to survive and thrive, were willing to explore every possible avenue, regardless of whether the economy was in a recession or not. During such uncertain times, purchasing a car was not a top priority for many individuals. Even with the advantage of low gas prices, which in some areas dropped below $1 per gallon, owning a vehicle required financial means and stability. As a consequence, dealer stock, commonly referred to as days supply, surpassed 90 days, well beyond the usual norm of the low 60s. On the surface, it may seem that having such a surplus of inventory would eliminate any sales issues. However, the unique circumstances stemming from the pandemic created crucial and complex challenges that impacted the car market significantly. The oceanic market tsunami. In 2021, there was a noticeable easing of restrictions and a return to normal operations. Whether it was the ideal time for this transition or not seemed inconsequential, as life had to find a way to move forward. However, if you missed the opportunity to purchase a car within the first quarter of that year, it became increasingly challenging. The supply issues with new vehicles caused by the superconductor chip shortage led to a chain reaction of high demand for used cars. Additionally, the lingering impact of the pandemic on the workplace further strained new car production. Then, in early 2022, the invasion of Ukraine by Russia occurred. While warfare brings about various tragedies, it also has significant and lasting consequences. Among these consequences is the disruption to the production of wiring harnesses in Ukraine, which has subsequently affected European vehicle manufacturing. The global pandemic, chip shortage, and war in Ukraine may be temporary situations, but they have resulted in permanent changes to the car buying experience. These effects have been evident in the past 24 months or so. In January 2022, buyers paid over 12.2% more for new cars compared to the previous January, while used vehicles saw a staggering year-over-year increase of over 40%. Edmunds' report revealed that a staggering 82% of new car buyers paid over the sticker price in January 2022, a sharp increase compared to a mere 2.8% the previous year. The question arises, when will these soaring car prices subside and return to pre-pandemic levels when consumers enjoy hot deals? During that time, the prospect of prices decreasing was not anticipated in the near future. People braced themselves for prolonged periods of paying premium prices for both new and used cars. Much of this situation can be attributed to the chip shortage, which had a significant impact on the automotive industry. The COVID-19 pandemic played a crucial role in creating this shortage, particularly regarding new car production. The silicon chips, essential components for modern vehicles, control numerous onboard processors that manage engine functions, infotainment systems, and even power seat memory data, among other things. It is likely that we have already passed the peak of car prices. However, predicting the trajectory of these prices is a complex and nuanced matter. Wholesale prices have already started to decline, and over time, this should lead to corresponding reductions in retail prices. However, the challenge lies in the fact that the initial benchmark was set so high that it will take years to return to pre-COVID levels. The chip shortage and the repercussions of the years 2020 and 2021 have had a significant impact on the market. In those years, approximately 14.5 million and 14.9 million vehicles were sold, respectively, in what is typically a 17 million vehicle market. This means that there are several million vehicles that people wanted to buy but couldn't, spanning multiple years. This unmet demand has now translated into a surge in the used car market. Typically, pre-owned cars become available 3 years after their initial purchase when leases expire. It was predicted that the volatility in transaction prices would stabilize once supply aligned with demand, which was expected to occur in late 2023 or early 2024 when automakers would be able to meet the demand for new vehicles. However, the pandemic has brought about a monumental shift in dealership strategies. The COVID-19 crisis presented an opportunity for dealerships to streamline operations, reduce incentives, and decrease inventory. Both car manufacturers and dealerships realized that having less inventory could lead to greater profitability. These significant changes in dealership models suggest that the discounts and incentives of the past may not return. Manufacturers will likely strive to maintain a balance between inventory and sales demand to keep prices elevated. This indicates that we may never see price levels equivalent to those in 2019. It is probable that over the next 3 to 5 years, used car inventory will be limited, leading to sustained high prices. There has been a slight decrease in the average price of new cars, albeit only by 1.1%. However, it's important to note that the average price still remains above $48,000. Interestingly, after a continuous climb for nearly 20 months, the average price of a new car has finally dipped below the sticker price. During this period, dealer markups played a significant role in driving up prices. However, in 2023, the supply of new vehicles is gradually increasing, leading to the return of incentives. With more vehicles available on dealership lots, competition has intensified and dealers can no longer command the same elevated prices as before. That being said, it is worth noting that the average price of new vehicles could potentially surpass $50,000 at some point this year. While the trend is towards a moderation in prices, the market remains dynamic and subject to various factors that can influence pricing.